Well, hello everyone. Today is April 24th. It's finally a Friday. I believe it's the last Friday of the month. I still don't know where this month has gone. I don't know where this year has gone. Time is just going by too fast. I think that's what happens when you're married and you have 3 kids and 6 pets. Oy vey. That's what I'm going to say this morning. All right, let's talk about global markets. Most global markets, US is still up pre-market, but global markets fell Friday as quick recovery hopes have been fizzling out. Investors look past economic relief and measures in US and Europe to focus on likelihood that reopening economies might take longer than expected. Now, here's where it gets interesting. A report from the Financial Times said an antiviral drug, and I'll talk about that in a bit, failed to improve conditions in patients in a Chinese clinical trial, cast a shadow over hopes it might turn out to be a potential treatment for coronavirus. And it's really sad because this drug made by Gilead Sciences, it was already in phase 3 trials, and there was a lot of high hopes, but it's not done yet. The report cited documents published accidentally by the World Health Organization. Researchers said the sample size was too small to draw scientific valid conclusions, and the trial ended early. Gilead Sciences, the maker of the drug, said the data represents inappropriate characterizations. In further news, the price of oil. Wow, talk about oil. What a surprise of the week. Continued to recover from a massive crash earlier this week. First time prices went negative. U.S. benchmark crude rose 41 cents to $16 in electronic trading after falling below $12 on Monday, though it remains well below the roughly $60 level where it began Friday. Can you imagine falling from $60 to $12? Take a look at this graph. And here's the interesting part. And notice every time it falls, it barely goes higher. It falls and then it barely goes higher. That's called the dead cat bounce. And I was talking about that recently. And there's a lesson to be learned here. And the lesson is, whenever you see a strong trout or a peak, always look to see the reaction from that. Because whenever you see the reaction, if you see a real big bounce, that's telling us that the reaction may be overdone. It may be a bit too much. But if you see a big dump like you saw right here, look at this. We went all the way from 54 all the way down to 29, right? Almost half of its value, and the market barely bounced. Couldn't even fill this gap. And then again, we went down here, and then the market went all the way to 22 and then rallied to 27. Notice that? So I'm always looking to see whenever, and this isn't a scientific or something you could really measure. I mean, you could use a 20-day moving average, but honestly, use your eyes. Look to see if the bounce is extreme or not. If the bounce from the reaction is extreme, that's telling us that maybe a little bit overdone. Like, for example, this is the QQQ. Notice when we dropped, look at how much we bounced. That's a bounce. But what we're seeing in crude oil is not really a major bounce. So let's talk about the major surprise for this week. We've had 3 surprises this week. The first surprise is it doesn't look like the drug that was supposed to work, GILD, Gilead Sciences, doesn't look like their drug is as effective or as promising as it was supposed to be. That was really big. The entire market softened after that news came out, because if this drug worked, then obviously it would help pick up economy much quicker. So that was the first big surprise. The second big surprise was crude oil going to negative, the May contract going negative. That was something else. And the third biggest surprise is earnings. No, I want to talk to you about that. So estimates have come down across the board as analysts have come to grip with the pandemic's full impact. The ongoing first quarter earnings season is helping clarify matters further. Even though the lockdown conditions currently in force covered only the last few days of March, and most management teams are simply withdrawing guidance. And that's a big problem. We knew that the numbers are going to be bad, but we wanted to see how bad the guidance is going to be. So get this, and again, this is the biggest surprise for this week, the earnings. S&P 500 earnings in all 4 quarters of 2020 are currently expected to decline on a year-over-year basis, with second quarter earnings expected to decline the most at 29.5%. So next quarter, we're expecting to see a decline of 29.5%. So anything better than that and the market will rally based on that. For the first quarter, reports are coming in at negative 14.7%. And the third quarter and fourth quarter of 2020 to decline by 16.30 and negative 7.9%. So we're looking for a pretty bad 2020. S&P earnings for full year 2020 are currently expected to decline 17.1%. This is down from a positive of 7.9% at the start of the year. So at the start of the year, we thought we were going to see positive 7.9. Now we're expecting to see a decline of 17.1%. Now, let me give you some specifics, but that's the biggest surprise of the week. So far we've had about 90 S&P 500 members report for first quarter. Total earnings on net income down 23%, with 68% beating earnings per share and 66% beating estimates. Not bad. Now, here's where it gets interesting. For the financial sector, we have about 50% of the companies release the numbers. So far, the numbers are bad. They're down almost 50% from the same period a year ago, with only 48.3% of the sector beating the earnings per share. So financial sector, not looking really good. But check out the consumer staples. We've also had about 50% of the stocks, 48.6% of the sectors come out. And total first quarter earnings so far are up 9% on 3.6% higher revenue, with 77.8% of the stocks beating EPS and 44% beating revenue. For the first quarter as a whole, again, as I mentioned, I'm just going to repeat this. First quarter S&P earnings aggregate net income is now expected to decline a little over 14% for the same period last year on 1.4 higher revenue. This is down from a close to 4% positive growth expected in early January. So we were expecting positive 4, and we're getting negative 14. Wow. Amazing, isn't it? That's the biggest decline we've seen in the comparable period in recent quarters. So again, first quarter, we were expecting positive 4. We're getting negative 14.2. For the full year, we were expecting positive 7.9. We're going to get negative 17.1. Keep in mind, these expectations are really, really important because that's what the market is going to appraise into their value. And if that continues, if the numbers continue to be kind of fairish, we may see more upside. What I'm really surprised about is the fact that the NASDAQ 100, which you're looking at right now, is still trading above the 50-day line, still trading above the 200-day line. The 50-day and the 200-day have not crossed yet, although they look like they may, and we're still trading above the 50-day moving average. Believe it or not, the NASDAQ 100 is in a bullish market, whereas the S&P 500 is still in a bearish market. We have to cross the 50 days trading below the 200-day, and we're still trading somewhat below the 50-day. Even if we were trading above the 50, we're still trading below the 200-day, and there's still a cross. So any way you look at it, the SPY, the S&P 500 is bearish, and the NASDAQ 100 is bullish. Now, there's one more thing I'd like to discuss before I let you go. I put together a training session on the indicator that allows me to buy stocks right before Wall Street pours millions into them. Again, the magic word here is before Wall Street pours millions into them. For many folks, this is an opportunity of a lifetime, a chance to collect profits so predictable that you could set your watch by them. And now you can learn the strategy that allows anyone the chance to collect paydays after paydays like clockwork, just like clockwork. But there's some very time-sensitive info that you need to know about this. And if you watch my video, I'll give you the trade that you could take advantage of today. As a matter of fact, I give you a couple of trades you could take advantage of today. You don't want to miss this. It's really time-sensitive. Click the link below or follow the button at the end of this video. You don't want to miss it. Again, find out how to spot stocks that Wall Street is pouring money into before they pour money into it, huh? I'm not kidding, folks. It's an opportunity of a lifetime, a chance to collect profits so predictable, you guessed it. You could set your clocks to it. You don't want to miss it, and I'm giving you some free goodies. And my free goodies are premium goodies. Follow the link below or click the button at the bottom of this video. Check it out, and you better have a great weekend. Talk to you guys soon.